Good afternoon, everybody. This is Christian Thwaites, Merritt Brown Janikowski. Welcome to our monthly market update. I think we have all of the technology squared away from different locations. So hopefully you're seeing up on your slide, up on your screen, the market update webinar with a nice cityscape of San Francisco. So this is our monthly updated what's going on in the markets and our kind of outlook for the next month or so. Obviously, we're going to have a fairly big challenge in November. We're down to the last 3 weeks of prehistorical election, as many of you know, and I won't try to recap the political news on this, but volatility has been pretty high recently, and the outcome of the election, I think the market is not particularly concerned whether it's one or the other. It seems to be pointing towards more of a Democratic sweep, but it's more how the election will be fought and challenged in subsequent weeks and months. And the only sort of real precedent that we have for this is in the last couple of months of 2020, going into with the Gore-Bush election, which wasn't a particularly happy time for the markets. There were other things going on as well, which also affected it. But I think definitely the 8 weeks we had of counting chads and re-elections and court challenges and eventually up in the Supreme Court was pretty unnerving. Whether or not we'll go through the same sort of thing this month, this year, remains to be seen. But I think that's what is probably keeping the markets a little bit on edge right now. And we've certainly noticed an uptick in volatility. So we're going to have a big challenge in November. But let's look at some of the other backgrounds to the market and where we are. So a quick summary of where we are. Here we are in the sort of middle of October, almost 6-7 months away from the inception of COVID, which we all thought was going to be fairly short and has obviously turned into something fairly permanent in all of our lives, and indeed in the wider economy. So what we're seeing, of course, is that the labor market took a tremendous beating in April and May with non-farm payrolls collapsing by nearly 20 million. In a couple of months, and then another 1 million or so after that. It's a very slow recovery. It is not V-shaped. It's sort of got halfway up the V on the labor market recovery. I think out of the net jobs lost was approximately 24 million. We've recovered some about 12 of them. So it's been slow to recover. Nothing really suggests that this is going to have a rapid improvement due to the various close downs around the country. And obviously some industries operating way below capacity. The demand for labor is going to remain pretty sluggish for some time out. I think to state the obvious, perhaps everything depends on the virus. We're managing for now. There have been some upticks in case rates and positivity test rates and things like that. And I noticed that some of the states which really didn't get hit the first time around, so the Dakotas and Indiana and Wisconsin and so on, are having a much tougher time right now. The Fed has expanded its role and somewhat of its mandate. It's changed its mandate. I give full plaudits to the Fed for stepping in very quickly back in February with that famous Sunday change and decision in the federal funds rate. I think they've stood behind the market at every turn they can, and they've offered as much support in the financial markets and with monetary policy as is possible. They can't do it all, and they've stressed that role many, many times. But for now, they stand as a pretty good backstop to the market, and at least it removes one area of uncertainty. Congress clearly. I had thought that with the expiry of the PPP, the guaranteed payroll program for smaller companies, and the supplemental $600 unemployment insurance benefits, which expired in July, would have been reinstated or partially reinstated by now. They have not been. There was a temporary fix with the White House moving some funds from FEMA, I think it was, over to the DOL, but those expired pretty quickly. So at the moment, the expired benefits are going to take a big chunk out of personal income levels. We've seen some recent improvements in the economy. They're real, but they're slow. Housing and autos and some retail sales have rebounded. You'll see in a minute that housing and autos are at very, very strong rates. That's a good sign. And some retail sales have actually done pretty well. And there's been more of a change in the mix of retail sales. So obviously a lot less eating out, a lot more eating in, a lot less physical retail stores sales, and a lot more internet and delivery retail stores. So if you kind of add all those together, there's been some net beneficiaries of that, and obviously some that have been hurt pretty badly. But on the capital expenditure, manufacturing, and trade, they're all pretty weak. We had one of the worst trade numbers in nearly 15 years published the other month, and that's in a month or a year when obviously the Chinese agreements on extra purchases of mostly U.S. agricultural goods was meant to have kicked in. They have not. So trade remains pretty weak, and the U.S. is actually in a rather interesting situation because of the stimulus, which was pretty big. It's actually sucked in imports more than would have been expected, and we haven't been able to, export the typical things that the U.S. is good at, which is capital expenditure and transportation and airlines and aircraft and so on like that. So a lot of that has meant that the trade side has become a net weakener for the economy, and probably will be for the rest of the year. There is an increase in the Treasury debt. It's been mostly financed by the Fed for now. I mean, it's not a straight dollar for dollar, but every increase in the federal debt is essentially being purchased on the secondary market by the Treasury. So it's not a source of worry. I think we're used to from the 70s and 80s and 90s and debt clocks and Rogoff studies and everything else to be very worried about GDP to debt ratios, but I think net they're not that important right now. It's much more important to keep the economy going and moving rather than have it kind of stall out completely. And also, of course, the interest rates, the nominal and the real rates on the Treasury debt have never been lower. So from that perspective, it's a good move for the Treasury to increase its debt through fiscal stimulus. I don't think there's any likelihood of us getting back to the 2020 to pre-COVID levels until at least 2021, and that might continue to shift. It's been slow to come about. And unemployment, we're going to be living with fairly high unemployment for quite a while. The headline unemployment's around about 8%, 7.5%. It's come down, but I think that's a little misleading because there's a lot of people who've voluntarily taken themselves out of the employment market, yet could come back. So there's a lot of slack in the employment market. They're coming back. They've taken themselves out because they haven't been able to, rejoin their companies, and so they're not actively looking for work, which means they're not counted as employed, or they are, temporarily, hopefully, not able to participate because of things like daycare and childcare and closed schools. So the wider unemployment number is more like 11 or 12. And I think that's probably what it's going to stay out for quite a while. Remember, it took an awful long time to come down after 2008, 2009. This is a different type of shock, but I think unemployment's going to take a while to tick down significantly. As I mentioned earlier, risk assets are very skittish. We've seen, days of very high volatility. We've just come off a good 5-day run in the S&P and the small company area, mostly because of the feeling that there's going to be basically a clean sweep through November, and that means a much better outlook for some economic stimulus, which at the moment, of course, is hung up and not going to go through. And as I mentioned earlier, the elections are an area of some concern. Historically, election years haven't been that interesting for markets. There's been some moves around elections, but there haven't been huge gains, winners and losers that you can count off with a lot of certainty and say, well, the market moved because the outcome of the election was different from what people thought. Actually, the averages for moves in election years are very, very similar to other years as well. So I don't think it's a major concern here about whether it's one administration or another. Quite frankly, they're both, one side is pretty moderate, the other one's kind of shown its cards in wanting to deregulate and lower taxes, and so either side essentially would be not too dissimilar in terms of the outcome of the market. But obviously, there's a big concern about how the election is composed and what the immediate aftermaths of the counting will be. Okay, so just to touch on a few obvious things. Interesting, this slide really hasn't changed much other than a number of days along the x-axis. It continues to extend. I mean, you can see there that Europe had a much higher peak. It's then kind of crawled back up as some parts of Europe took a first wave. Other parts of Europe, like France and Spain, and to extent even Italy at the bottom there took are beginning to see a little bit of an uptick. Note this is a log graph, so their numbers are going up in the case of Italy from 10 to 20. So it sounds pretty dramatic, and it is, but in absolute numbers, the numbers are still pretty low. And there's the United States, and I think we all know that this curve has really been very stubborn to break, and it looks very different from state to state, but overall we're we're right up there, and as long as that happens, then regardless of whether there are official close downs or voluntary ones, there's large parts of the sectors of the markets and the economy which aren't just going to function at their full capacity. These are some of the increases in the US. So again, kind of a busy slide, but I kind of take your eye down to the bottom left-hand side, and you've kind of got the daily changes, some of the hospitalizations, and they've ticked up really. And then you've got a number of those states I mentioned earlier, the Dakotas, Wisconsin, Wyoming, Arkansas, and so on, which are seeing a fairly big tick up in the number of cases. A number of these states are also testing way above 10% in terms of positivity rate. And WHO puts 10% as a threshold for alarming. I think California is around about 2.5. So there is a wide discrepancy between those states which seem to have some control over the spread of COVID, and others which are taking a different approach. So as on a national basis, we're still not out of the woods. As I mentioned earlier, the Federal Reserve is really on point. There's a very dramatic increase in the balance sheet, kicked off right in early 2020, just after the first hits of COVID, and the balance sheet, went from 4 to 6 trillion in the space of a couple of months. It's leveled off a little bit. They're still adding to the Federal Reserve balance sheet. This essentially they're buying. This blue line, the blue is just what they're buying in mortgage-backed securities and federal debt treasuries. Everything from 30-day bills all the way out to 30-year, or they tend to sort of buy at the shorter end than the longer end. And then you can see the annual change year over year, 79%, pretty much the same as it was in September. So we'll see a flattening out of that. You can see the weekly changes come down quite a bit as well. That's the black line. So they're still there. The number is still very large, and they're adding to it in a kind of a systematic and predictable way. And they're on point. They're doing what they need to do, and they're going to be committed to it. Since we met last time, there's really been very little change in the major 10-year, 30-year, and 2-year notes. The 10-year note has come up a little bit in the last few weeks, from about 65 basis points. It hit as low as 0.5%, 50 basis points. It's ticked up. I think some of that's just more seasonal, and a feeling that there might be a little bit more inflation than there was. I mean, COVID was very much a deflationary event. So the feeling is that there might be a little bit more inflation from a much lower base. But really, those numbers are still pretty low, and you can see that the black line is with the 10-year benchmark is really sort of moving between a fairly tight band. Don't really expect much of that to change on the Treasury side. The Fed came out at the end of August with a kind of an interesting restatement of its goals. It's always had full employment. And managing inflation. They haven't usually put numbers around it, although the inflation number is always perceived to be around about 2%. And kind of stable monetary policy, those are their goals. They tried to put a bit more flesh around it in August by saying essentially they would be looking at average inflation. So before the thinking was at the minute inflation popped up to 2%, the Fed would be ready to hit the brakes. And they said, no, we're going to let it run over 2% so we get an average of 2%. Now, they made sure not to specify what they meant by an average. Was it 3-month average, 1-month average, 1-year average, 2-year average? Doesn't really, we don't need the specificity right now. All we needed to know was that they're going to allow inflation to move at above 2% without slamming on the brakes. Now, so the other one is what they consider to be full employment, which is around about 4%. It's always some unemployment in the economy as people moving from job to job, or things closing down before people move on to find new jobs. So zero full employment and zero unemployment are not the same thing. So the unemployment number, which they kind of talked about, was 4.1%. Well, here we just look back and just look, okay, how many times did we hit unemployment at 4.1% and inflation at 2%? The answer is, 4 times in the last, nearly 70 years. So this is not, what they're really saying is that these are two numbers which don't get hit very often, which means that for the Fed, they're not going to be wanting to move anything on the rate side until we're at least converging towards those still numbers. Right now we're on, at 8 and 1.3. So that is a very, very long way from having those two lines, hit 4 and 2 respectively, which is I've shown in the shaded bits. So, expect rates to remain low for a very long time. The labor market, my gosh, it has been very slow to come back. This is again a log graph. So over on the left-hand side, for most of the last 2 or 3 years, we've been looking at, new claims at about 200, 230,000. A bad month might be 250,000 a week. They obviously skyrocketed in the weeks right after the pandemic. 6 million, 3 prints at 5, 4, 3, and then it's slowly come down. And you can see most of the improvement was done by August, and then since then it's been pretty flat. I mean, it's come down a little bit, 1.1, and then it's in the high hundreds, and it's kind of stuck around there. But for those of you who read the blog will know that this is only half the story, because there's at least the same number, depending on the week, who are filing for a different type of claim, the PUA claim, which is the Pandemic Unemployment Assistance Program, which is for people who are not typically eligible for these types of claims, where you have to pay it into the Social Security and Unemployment Reserve Fund. So for gig workers and those self-employed who wouldn't normally be eligible for the claims, this PUA program was set up, and the number is roughly the same. It depends on the actual month, but on the actual week. But the story here is that it's been a very slow market to come back, and we seem to be kind of stuck in this 800,000. And just as a way of context, the highest number we ever had before was a single month of 680,000 back in 2008, and a similar one in 1981. So these very unusual numbers, and they're kind of sticking around here. So this labor market is in flux, very slow to come back. These are the new farm payrolls. Again, apologize for the axis. You can see that we had, an 800 way down the bottom, the blue bars with the broken jagged bits, 800,000, 22 million. And then we go back up to, 4 million, 5 million. And the last one, couple of weeks ago, was 660,000. Now, this is the last non-farm payroll print before the election. The report comes out on the first Friday of the month, and this year that Friday is on the Friday after the election, which is on Tuesday. So it won't be. This is the last one that's kind of available for anyone to use to their discretion. But this is not, again, healing particularly well. We need a lot more job numbers to be able to get back to where we are. If you kind of net all these out, we've lost about 22, 23 million jobs. We've regained about 10 or 11, so a long way off. I do put the hourly earnings in here, which have a big spike. It looks at the bottom, 4.6%, but those are very, very distorted right now, because a lot of people, the job losses were primarily at the lower ends of the earnings spectrum. So they were taken out. It left a pool of higher paid people left who are being measured. So it's equivalent of Bill Gates walked. If Bill Gates was in a stadium and everyone else walked out and he was left by himself, the average income of the entire group would go up just because you've taken out the lower paid. So we got to treat some of these numbers with a pinch of salt, given what the scale of the shutdown and the effects. This makes us a bit nervous. Permanent job losses really happen when a company goes bankrupt, company calls it quits, company gets merged, closes a plant, closes an office, closes a store, closes a regional hub. All those ones which say this job isn't coming back. And they've begun to creep up, as you would expect. I mean, the first time round was like taking a forced vacation for 3 weeks, a month, 6 weeks. But then there are some companies which are just not going to be able to come back again at the levels that they used to before. I mean, think of like an airline or a hotel, which can only keep its full staffing complement, for for a limited time before there's going to start bleeding red ink. And so eventually these job losses seep over as permanent job losses. And this is a concern because it means that people are out of the labor force for longer. It's harder for them to find jobs that match their skills without having to move or do some other fairly big things in their lifestyle. So again, we're kind of watching this one because if the number of permanent job losses increases, then consumer confidence goes down. We had this enormous GDP decline, 31%. The current expectations over on the right-hand side are about 26% for the first quarter. Now, this number will come out for the third quarter. The first print for the third quarter is very much an estimate. It'll come out at the end of this month, and there will be discussions about, oh, we've had the best GDP quarter on record. That's true. It will be a pretty big number, but it won't be anything like enough to recover what's been lost, where we had a -5 and a -31. So just kind of watch out for those headlines. There'll be a lot of bragging rights and then corrections and things like that. But basically, the economy is going to be down about 9% this year. These are all annualized numbers, but just to kind of take it into kind of more understandable numbers, the economy is going to be down about 8 or 9%. There'll be some slow recovery coming back in the third quarter, which is now finished, of course, but it's going to be a little bit slower in the fourth quarter. We've kind of penciled in, 4.5%. It might be a bit lower than that. We'll have to kind of see how the labor market works out over the next couple of months. This is the just the number of people employed. It fell this, so about the workforce as a percentage of the population is about, fell below 52%. It's been going down for a number of years. Peaked in 2000 actually at about 64% for a number of reasons. Some demographic participation rate has come down quite a bit. It took a big hit in the 2008 crisis, clawed its way back to about 61%, and obviously took a big hit. Now it is coming back relatively quickly, but this is a function of how many people take themselves out of the labor market. But the bottom line, of course, is that less people are working, and we haven't yet got anything like back the number of jobs that we lost. Again, these are just the same number, but by different cohorts. So the top line, the blue line is the 25 to 34, and that took a big hit from about 83% to 80%. These have all come down in different age groups. The only one that's shown any resilience is recently is the 45 to 54. So again, this is a recession where younger people, lower pays, and in jobs with a lot of forward-facing types of businesses. Those are the ones that have been hit the most. These are some of the sort of current activities that you can track on a daily basis and see if the recovery is coming up. They all pretty much tell the same story. This is the TSA checkpoints up here. So there's a number of TSA passengers coming compared to blue. The blue line was 2019. There's some seasonality in here. People travel a little bit more in the summer, a little bit less in the fall. And then this is kind of what it is, the bottom line in 2020. So it bottomed out early in April, May. It's come back a little bit, but it's essentially flat. Hotel occupancy, same story. They plummeted to very, very low levels. This is a percent of the 2009 levels. So they were at 1.20%, 80% below the 2019 levels. Sorry, they have increased a little bit, but most hotels are around about 50% of capacity. And finally, this is the number of commercial flights, not passenger flights, but commercial flights, which are around the world, which are FedEx and UPS and similar types of companies, which are hauling high value traded goods around the world. And the number of flights, typically is about 125,000 a day, and they obviously fell by a large amount, about 25,000. They're back, but again, you see the same story in all of these. Nice recovery, but stalled out. One thing, moving to the consumer, because we really have to think about the consumer when we talk about the economy and the markets, is the consumers are very nervous about taking on debt. So this is revolving and non-revolving debt. It's not mortgage debt. It's typically credit cards, auto loans, home equity loans, the loans which sort of affect consumption. And uh, the this is the change in the month, in billions. And so you can see over on the far right hand side, essentially people have done what they tend to do in recessions, but they've done it far more dramatically as they've taken down their debt. They are not, consumers are simply not willing to, go into periods where they're concerned about jobs, job security, longevity in their jobs with a high debt load. So the percentage change down here is very, very low. Now that's good and bad, in the sense that it's good that there won't be a lot of people who are strung out on debt and they miss a month's or a week's worth of wages and they're going to start to default. And for the banks, they're not looking at any major write-downs of credit, but the banks are also not making as much money through these loans because there are fewer of them, and also this tends to hurt consumer spending. So we have unlike 2008, where people were just enamored with debt and had to dig themselves out of that hole for many, many years. The debt load here is extremely low, and people are trying to reduce it as fast as they can. Consumer confidence, this is just measures how people feel about the economy. Took a big hit. Levels are about 120 down to 83, 84. It's rebounded a little bit, but again, you can see the under 35s. I hope it's showing up a little bit. It says the upper line. They were way up here, 143, 144 on the index, and they're way down at 92. The over 55s have actually had a recovery, as have the general population, but again, the under 35s have had big downward changes in confidence, and they haven't seen any improvement in that. A couple of bright spots. First one is that people are buying cars. This is almost back to the peak. The US roughly sells about 16, 17 million in a good year. In a bad year like 2009, it can go down to 10 or 11 million. And in fact, it dipped down there on an annualized basis back in March, but it's come back very, very quickly. And I think this is, people who have jobs feel confident about buying a car. Also, the credit terms and the prices of cars have come down a lot. A lot of car manufacturers had high inventory levels, so there's some pretty good deals to be had in the summer months and even up till now. And of course, the other one is that people who worked and relied on public transport are now thinking that they don't want to do that, and so they're buying cars. So it's driven by good prices, good deals, easy financing, and also some changes in the way people are thinking about getting themselves to work. And then new home sales. This is again, that number is the number of new home sales. Hit 1 million, and that's close to 12-year, 13-year peak. And again, this is a result of slowly as an uptick in new home sales. They fell sharply in the first couple of months after COVID, and now they've gone back up again. Again, this is people who are in jobs and are thinking of moving out of cities, or thinking they're going to have to permanently upsize because they're using their front bedroom or their child's bedroom for working at home activities, and so they're having to, or they want to increase their living space. So there's this has been pretty good part of the market, and then mortgage rates, you can get sort of mortgages at about 3% or so. So that's generally been a bright spot, and I think it will continue to be. Although, at some extent, the new houses that are being built needs to catch up with this, because the number of new home sales is exceeding the number of new houses being built. So there will be some catch up on that side. So turning to the stock market, I like to show this slide because we see a lot of volatility in share prices. As we always say, share prices change much more often than the fundamentals, and try not to confuse the two. So we saw this big downturn in the market. This black line went from 3,200 to whatever it was, 2,400 in a blink of an eye, and But on the earnings and dividends side, things have been pretty good. The earnings, yes, we're in the process of seeing those fall, looking at about $122 versus about $145 for the S&P. Most estimates have this number increasing. I think they're right. Quite rapidly over the remainder of this year into 21, 22. And some estimates have this number, the 122, at about 200 by the end of 2023, which brings the market valuation down from about 20 times to 16 times. So gradually, earnings are, did not take as much a hit as the prices, did not take as much a hit as the economy. And I think, we're going to see some quite respectable increases in earnings per share for the stock market, over the next 6 to 9 months, unless there's some, huge setback that none of us can really predict. But at the moment, even if the Biden administration increases the corporate tax rate from 21 to 28, which I said they do over a number of years as opposed to straight away, these earnings per shares are not dependent upon the tax rate that much. So I think we're going to see some positive numbers there. And on the dividends, certainly some industries, some companies, decided not to pay dividends, airlines being an obvious one. The financials, the banks were told by the Fed, pretty unequivocal terms, not to do share buybacks or pay out dividends. So they have, reluctantly gone along with that. But other than that, dividends have held up pretty well. We've kind of gone from about about $63, $64 a share to 59. Now, a lot of companies in the S&P don't pay dividends. About 120 of them don't. And some of the bigger ones certainly don't, like Amazon and Facebook and Google. But for those that do rely on dividends, this has not been, a huge concern, and a lot less than the collapse that we saw around about 2008, 2009, which is driven by financials a lot. We're seeing a slightly better showing in small cap. I just checked these numbers from when we met a month ago. So the top 5 companies continue to power ahead. These are the Apple, Microsoft, Facebook, Google, and who am I missing? Amazon. Those are the big 5 guys. This has been very much a market led by them in terms of their profitability, their ability to benefit from the work from home, buy from home trends, cloud storage, people wanting to upgrade their devices. All these things, play right into the hands of these tech companies, which are hugely, hugely profitable. And despite this kind of moves to re-regulate them, and there was this big report that came out last week from one of the House Subjudiciary Committees or Subcommittee on Judiciary, I can't remember which. But anyway, it's available. There's a link to it on our site. It's 440 pages. I wouldn't bother to try and read it, but the bottom line is that they think that 4 out of the top 5, so that's not Microsoft, but Apple, Facebook, Amazon, and Google, are also practicing market competitiveness, which needs some scrutiny. Now, whether or not it comes to break up or anything else, don't know. These usually things take years and years and years to come about. I mean, there's just only been recently a settlement against Tyson Foods and another company, I can't remember which, for fixing chicken prices, and this was very blatant. And they were the 3 of the companies. They own 80% of that market, and they price managed, and it took 12 years to come to fruition. So this will take a long time. The broader market has begun to come up a little bit. There you can see that the S&P 100, top 100 companies, up a little bit. And then small companies and mid cap, that's the 2 bottom ones, the black line and the kind of white line, have picked up quite a bit recently in the last month. You can see there's a nice uptick to that. So they're beginning to close some of the gaps which they had before. So it's been a large cap story. It's been a mega cap story. Small and mid cap seem to be certainly getting better. But overall, if you kind of look at the S&P 500, which is capitalization weighted, so the top 5 companies account for 15-20% of the index, the so-called FANGs. So you throw in Google and Netflix and Nvidia and a few others like that. It has powered the market up to about 9.1, up 9%. This is index from January. But the median price of the S&P, which is the equal weight, where every company is just 0.2% of a portfolio, is still down. So so there's still a lot of catch up for the broader market to work, and we'll be one for looking for a more dispersed type of recovery as we kind of go into the fourth quarter and into the new year on the stock market. This is interesting because we take the energy and financials, which have lagged terribly at the bottom blue line, and not just for 2020. They've lagged for a number of years now. Energy used to be around about 16% of the S&P. It's now around 2%, and that's all the Chevron and Exxon's and Phillips 66 and a bunch of other companies have just had a miserable time, and they've become a far less important part of the stock market on a stock market weighted basis. Same with financials. Whereas the tech and consumer have kind of powered ahead. So this is, you could argue, old economy, new economy, doesn't really matter how you define it, but there are some areas which have really continued to do very well, and there's some industries like energy and financials where it's very difficult to see them, moving powerfully ahead, given the headwinds they're facing on a secular or even a regulatory basis. Mentioned earlier about stocks really not being influenced by elections. Now, this sounds sort of counterintuitive, but just kind of went back and looked at election years, and you can see some, mostly they're up, and there are a few which are down. 2008 being a big one, but they aren't necessarily because of what's going on in the election. There's some other powerful forces. 2008, obviously, in the middle of the huge crash. Of the financial and property markets, and in 2000 a similar big correction coming out of tech, which started in early 2000 and just happened to accelerate after the election in November. And actually these numbers aren't very different from the broader market. So I would say that we're probably going to be in for a little of a bumpy ride, but I think the market is sort of pricing in the economic and business fundamentals, which are probably more important than who gets in. But if there's again, because their economic policies are not that different, they might be different in terms of how they're executed or what they say, but the net result for the economy and the market's not that different. So I think the market's more worried about, okay, is this going to be a prolonged kind of negotiated election? And if so, that's going to mean that consumers are going to be concerned about spending and getting out there. So yeah, this is the kind of big update for where we are in kind of going into the last couple of months. We still think that US large caps will remain in focus, partly because of tech. I mean, these are money-making machines and they're monopolies, or very near it. I mean, Google, 90% of the market. So Facebook, similar number for social, kind of social sort of interactions on the internet. Apple, I don't know, 70-80% of the mobile operating system market in the US, and about 60% in the rest of the world. And between them and Android, that's about it. There's a few other, maybe Nokia and BlackBerry is still around somewhere. I don't know, but they aren't really relevant anymore. Amazon, depending on how you measure it, retail sales, pretty large. I mean, they would argue that they've only got 10% of total retail sales, which is about right. But in terms of internet retail sales, they've got a much bigger number, and they're pretty ruthless competitors. But we'll see whether or not they whether the re-regulation hurts them at all. I don't think it will. I could be wrong on that, but I think that these companies are very dominant businesses. I think we're going to get more October surprises. Those of you who've been around remember these from 1972, when there was a peace announcement initiative by Kissinger about 3 weeks before the election, and then there was the ones in 1980 to do with the hostages, and of course there were plenty of them in 2016 with the emails and the FBI reports and things like that. So who knows? There could be others. Just hold on. We're not taking any aggressive new positions going in for the next 2 or 3 weeks. We continue to sort of add a lot of protection onto the stock market. I think international's on kind of a slow upward bend. It's getting slightly better, particularly Europe. Japan's still a bit sleepy. We do see a kind of lower dollar in the future. mainly because of trade issues and people wanting to diversify out of the dollar, but that's going to be slow. It's actually helped us a lot on the international side the last month or so. We are right about the permanent job losses increasing. I think I've talked about that, but also rates really going to remain very low for a very long time, especially at the short end. The Fed still has a lot of tricks it can do. I say tricks, I don't mean in a bad way. I mean there's a lot of tools that a central bank can do, which they haven't done yet. Others have. So it gets a bit technical, but they can sort of do things like buy at different parts of the market. They can buy equities, they can buy REITs, they can buy all sorts of things. And they can give a lot more, overt direction about what they're going to be doing. So the central bank is, Federal is on a full ease mode and possibly, could do more. We are looking for income replacement for consumers. They've got a big number coming out of about $1 trillion worth of spending has been taken out of the economy on an annualized basis since July. So that's got to be replaced. I don't think it's going to happen until the new year, unfortunately. That's probably got some implications for rents and spending. I think we might see an uptick in rent forbearance in the next couple of months. I don't know whether that will be, people being evicted, because in this market, who are you going to rent to? And there are still some big restrictions about evicting tenants, either both on a federal and on state and on a local level. So might not be great for landlords who have those types of properties, but I don't think it's going to be a big social concern with people having to miss their rents and then finding themselves out on the streets. I might be wrong, but at the moment I think the fiscal support is coming. It's a question of waiting for it. And so I don't think we're going to see a lot of foreclosures, and credit card debt, as I mentioned, is really not a thing right now. But everything really depends on the reopenings and the pace of that, and not just on the formal reopenings. As you know, things can reopen, but people can still voluntarily distance. They can say, well, yeah, this sports event, this music event, this restaurant, this hotel may all be open for business as normal, but our family doesn't really want to take on that level of risk exposure, so they kind of self-discipline and spend less, and so that's going to take a long time to get back in. If and when there's a vaccine. Well, I'm sure there will be. There are 3 which are in pretty good trials right now. There's another 15 right behind them. There will be a vaccine, but in a question of when is, of course, a big open-ended question. And finally, for those of you, our clients, we have put a lot of protection on the portfolios. As we know, we use buffer notes, we use treasuries, probably keep on our treasury position at least through the election. They don't yield very much, but boy, if there's a problem in the markets, that's the first place people will go to. So for the moment, treasuries are important, pretty part of our bond portfolio. We might begin to think how we change that over the next 6 to 9 months. So hang in there. There's going to be again a lot of volatility. Whatever the October surprise is, I wish I could predict that, but there'll be one. We aren't done yet, so it will be tricky. But I do think that the market's uptake has been impressive, good, well warranted. We're going to write about that in our quarterly report. It's absolutely well substantiated by what companies are doing and how much they're earning, and so we're not concerned about the overvaluation of the market. But as I said, just hang on for a few months of high volatility. That's it. I think we have a couple of questions. I'm going to see if I can find that. Let's see. I think I might have to stop the share, and then you'll be able to see everything that's on my computer, or not see. Okay, let's have a look. See if there's a question here. Here we go. Great info. Looking at point number 7, your update slide concerning likely volatility. What are the plans for your portfolio strategy in the next 3 to 6 months? I think hopefully I've touched on a little bit of that. I think we continue to like these buffer notes. These are the notes which provide market participation on the upside, and also, more importantly, protect on the downside. So we see some pretty good deals on those. Most clients probably got a 5 or 6% position in that. We also have things like the dividend aristocrat portfolios, which we think are inherently less volatile than the market as a whole. And then, as I mentioned, on the treasury side, we used to have a large exposure to treasuries directly. in the 7 to 10 year space, but also through our bond ladder. If you haven't got one of those, please give us a call or your wealth advisor a call. And then I think we'll kind of see how that works out through the election. And then at that point, you could probably find some slightly better deals on the credit side and 7 to 10 year treasuries. But for now, it feels awfully good to have them. If there's a political mess, then treasuries are going to have a pretty good run. How would you honestly rate your performance with regards to the portfolios that you made year to date during the pandemic? What worked and what didn't? That's a difficult question because people have different portfolios based on their risk tolerances. Some people have more cash. So it's difficult to point to a typical portfolio. I think what we did was we moved into a selected tech portfolio that's done very well. We reduced a little bit of our holding in Berkshire, so that was a good switch that we made. We could have, we could have maybe brought our small company exposure down because they had a kind of a 6-month underperformance, but that started to come right, so I'm not too concerned about that. And on the bond side, we were probably, the treasuries did all of their work in February and March, and we did really well. They're up like 11 or 12%. Since then, they've been relatively flat. We could have done a little bit more on the corporate debt side, but hey, corporate debt can move like equities. And so you kind of got a double exposure if you're on the equity side and loaded up on corporate debt. And for now, we're not out of the woods, either on COVID or on the political side. So yeah, we could have got maybe, eked out a few more basis points of return, but it would have been with quite a bit more risk. And I think the other thing, I mentioned the notes have done pretty well, and we weren't caught in any parts of the market which have taken a real beating, like energy and financials. So like all portfolio strategies, we just done more of the good stuff and less of the bad stuff. But on the whole, I think we're kind of okay with what we've done for clients, and hope you are as well. You're welcome. Okay, where does the financial health of the state of California and its municipalities have any impact on your portfolios? Rode Caltrain during the rush hour this AM and had a whole car to myself. That must be a money pit. Good question. State of California is actually in reasonably good shape, primarily because of what Jerry Brown did on the reserve fund side. So there's still a fair amount of general obligation cash available. I mean, yes, California is going to be hit. California revenues typically come from income tax and capital gains, and then some residual from property tax. And then the others are kind of like normal fees and stuff like that. But so, yeah, I think something like a transit bond is obviously going to have a harder time than a general obligation bond. But it's not across the spectrum. The Golden Gate side, I'm pointing because they're down there, they're doing okay. I mean, volume and traffic is down on their ferries and on the bridges, but they're not down as much as an empty Caltrain car, I don't think. And it's the same with schools. Some schools are in very good districts and well supported and still being financed well, even though they might be operating on a semi-open, semi-closed basis. So you've got to really kind of pick your cities, pick your revenue source, and pick your credit. And then others like tied to utilities, particularly water, electricity, they're kind of fine. But generally, California credit is pretty well sought after. The big four municipal issuing states, Texas, New York, Pennsylvania, I think, am I missing? Probably Illinois. They're considered one of the best. So I think California's spreads on California munis have come in quite a bit. They're a little bit wider today than they were a few months ago, but generally they've been pretty good. So I guess the answer is it depends. Good. Well, I think think that's some. Thank you. Thank you. You're very welcome. So thanks very much, everybody. We will be posting this on our website. I think. I hope I'm not wrong on that one. But as always, if you have any questions, please call us at the general number or your financial advisor. And now, so very nice to see everybody, and we'll see you next time. And I will now read the disclosure. So here we go. Discussions of the investment strategy, research, investment process of Brown Janikowski are of the date indicated as of the date of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the types of investments mentioned in this presentation will produce the intended results or outperform any other investments in the future. We reserve the right to change our investment perspective and outlook without notice as market condition dictates, as additional information becomes available. Diversification does not protect the investor from market risk, does not ensure a profit. The information is subject to unintentional errors, omissions, and changes without notice. All sources are from FactSet unless otherwise noticed. While we gathered this, unless noted otherwise, while we gathered this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in this presentation. References to individual security should not be considered as a recommendation to buy or sell that security. Securities noted in this presentation are only several of successful and unsuccessful investments by Brown Janikowski and do not represent all the securities we have purchased, sold, or recommended. Index returns include reinvested dividends, interest, but do not reflect commissions or transactions costs. Mutual fund returns include reinvested dividends and capital gains distributions. Mutual funds are a net of the fund's expenses, however, they do not reflect Brown Janikowski's fees. Please read the prospectus carefully before investing or sending money. Past performance no guarantee of future results. We may reference various hypothetical investment illustrations. These are for illustration purposes only, not investment recommendations, do not guarantee indication of future results.